Okay, we already have some ish. So great, people are pouring in. I think, what we'll do from our next webinars is for the first 5 minutes, we'll have some good music also alongside, just to get in the groove while discussing finance. Okay, Jayesh Bhai is here. Vinod. Hi Vinod, how are you? Jayesh Bhai, how are you doing? क्या बात है? So should we? So what do you say, Saurabh? Should we start or should we take another 4-5 minutes to start? Saurabh, you're on mute. Unable to hear you.
Not 4-5 minutes. Maybe you can wait for a minute and then we can start.
Okay. Okay. Good evening, Vinod. Vinod is a good, I know him, he's one of my good friends. He's very damn good at looking at mutual funds and all. I'm pretty sure आपके session के बाद he'll be able to take one more session on it. All right. Let's start. Okay. So good evening, everybody. Thank you for taking your time out and joining us on this Thursday evening. As usual, it's always a pleasure, to be learning from Saurabh Mittal. And like I said the last time, is I have all the pleasures to be learning from him. By sitting next to him, as well as learning with you on this webinar as well. So Saurabh, if you can just share the screen and with your presentation, and I'll do a bit of introduction and we can go through. So in the meantime, Saurabh, he's regular at radio every day. He speaks with Rishi K in the morning. There are some sound, he does those radio bites for 2 to 3 minutes, and which has become very popular and very powerful over the last couple of years that he's been doing. One of the only persons in personal finance industry to be on radio consistently, as well as he writes for various magazines and newspapers, and he gets quoted by different newspapers as well. So here you go. He's with Rishi. Both of them look quite similar as well. So okay. So with that, as we ended the last webinar, it was about where we were discussing about different avenues of investments, and one of the things was reading a fact sheet. Today, what we're going to do is we're going to talk about the fact sheet in a little bit more detail, so that we can do a very focused conversation on it with Saurabh. So I request all of you guys, to if you have any questions, just drop into the Q&A box, and we'll be more than happy to answer that to you. So Saurabh, over to you. Let's begin.
Yeah, just a second. I'm just starting to share my screen. Maybe what you can do is, by the time you can run the first poll.
Surely.
So welcome everyone. Thanks a lot for joining in and taking out time for this session. We are starting with this first poll, and just to gauge as to where you are in your journey of investments in mutual funds. So to understand what is the majority of people who are attending here. So the first one is a single choice question, and second one is a multiple choice question. So you may be an investor, but maybe you have concerns, you're not fully invested into it, and there are some concerns. So obviously there are multiple choice. You can choose any of these concerns, if at all you have already while doing mutual fund investments. So please take your time and answer the questions on the poll, please.
So Saurabh, a lot of your work life will be easy because most of the people are really, they've invested in mutual funds before. So what I'll just end the poll in the next half a minute or so. If anybody or any one of you has not.
Yeah, we see only 60% of the people have opted to answer the poll. So request everyone to just participate fully in this.
All right.
Yeah.
And the poll and
publish the results.
Sure.
So great. So we have almost 88% of the people saying that they are already mutual fund investors, which is a very good thing to know because then we have quite a matured audience here. And obviously we'll try to revisit few of the fundamental basics of understanding different types of mutual funds and reading the fact sheet. Similarly, what we also see is that although 88% of people have invested in mutual funds, but only 40% people are like fully invested and are investing without any kind of concerns. But 40% of the people feel that although they are invested, but they still find it difficult to understand what mutual fund is really, mechanism, how it really works, and how we can really take control of our portfolio. And then there are other answers to it. Some people are probably putting it in chat as well, so we'll definitely go through it. Some people say that they're not fully invested because they fear volatility. We'll try and see how we can understand mutual funds better so that it can take care of all these concerns. Great. So with that, let's start with our presentation. I'll just stop sharing this poll. Sorry about this. This presentation was not updated and just got updated. Great. So let me just first let us just start with a simple video. I think it's a very simple 3-minute video for us to understand what mutual funds are, and we'll start building up from there. So, Jinay, would you want to play on the, or I'll just play this video.
What is a mutual fund? Mudra Pandit has always dreamt of building a house of his own and taking his family to Europe for a holiday. To fulfill these, Mudra has been saving small amounts in saving accounts and fixed deposits. However, his investments are not growing at the rate he would like them to. Mudra is now looking for an avenue to maximize the earnings on his savings. A little bit of research shows Mudra that for investors like him, mutual funds can be an option to explore. Let's understand how a mutual fund works. Suppose Mudra visits a restaurant and feels like having 3 different types of pizzas, but has money for only one. He could invite 2 of his friends to share the meal with him. The 3 of them could then together buy 3 pizzas and share 1 slice each from each of the 3 pizzas. This also means that in case one of the pizzas is not to their liking, they still have the other 2 to ensure an overall enjoyable meal. This is exactly how a mutual fund works. It pulls in money from several investors to invest in a variety of instruments. This tends to lower the risk. When Mudra buys 1 unit of a mutual fund, he actually owns a small part of each of the instruments that his mutual fund has invested in, such as stocks, bonds, and other securities. Mudra has neither the time nor the financial expertise to decide how he should divide his investment between these multiple instruments, in order to extract the greatest profits. This is where a professional fund manager in a mutual fund comes in. The manager divides the investments not only between different instruments, but also into various sectors within the same instrument. For instance, a mutual fund manager may decide to invest in shares in the cement, telecom, IT, and infrastructure sectors. Even if some of these sectors perform poorly, there is a likelihood that the performance of the other sectors will make up for it. Many might think that the cost of having an expert fund manager would be very high. But the best part about mutual funds is that the cost of professional investment management is shared by all the investors, making it low per individual investor. Important points to remember are: mutual funds pool in money from several investors. Mutual funds invested in a diversified portfolio. Mutual funds are managed by professional fund managers. The cost of professional fund management is shared by all the investors.
Sorry. Okay, so as we saw in this video, let me just sum it up for you. And I know that most of you are already mutual fund investors, but let me just sum it up to you for this basic things about how mutual funds work. So basically, mutual fund, the biggest advantage or the two biggest problems that mutual fund is solving for an investor is diversification and professional fund management. So because even if you're investing a very low sum of money, the money is actually invested into 40, 50 different stocks. You get your investments diversified, not only into various stocks, but also into various sectors. And because this fund is professionally managed by a fund manager, you don't really have to worry about what are the trends that are picking up, what stock should be bought, should be sold, or should be kept on hold. So there's a professional team of fund managers who are fund managers and analysts who's taking care of your money and who's managing his money professionally with a very nominal fees. So another big feature of mutual fund is that it is a pooled vehicle where collective money and expenses are shared. So if I am an investor, you are an investor, all our money is pooled into one scheme. And that is why it is called mutual fund. And that fund as a whole is then managed by a fund manager. And as it was shown in the video that because all of us are putting money in a fund, the fund size can really grow up and it will enable us to diversify into this 40, 50 stock, which probably I would have not been able to do with the amount that I would want to invest with. Next point is that it is not an asset class; it is just a medium to invest. A lot of times we see that very investors who are very novice who just started investing, they feel that if they invest in an equity mutual fund and they invest in equities directly, they are actually diversifying, which we all know is not true. Because ultimately, if the money is going in the same asset class, when it is in equity mutual fund as well as equity, they are going to behave in a similar fashion if there is any systemic risk to come. And lastly, never select or reject a mutual fund based on NAV. I mean, NAV is the most overrated and an overrated kind of number that people see that, we'll invest in a fund because it has a higher or a lower NAV. And at times we have seen in the past that a lot of people bought into a fund just because it was a new fund and the NAV of that fund was at 10 rupees. So let me just quickly get this.
What is a mutual?
Sorry about this. So now with that as a background, let's start with what are different types of mutual funds. Before we start, because we just spoke about NAV, Jine, can you run the second poll, please? Just to know where people are and how are they thinking.
What is the full form of NAV? And here it comes.
Awesome.
So just 10 seconds more for those who have not taken them.
I think you've already seen 90% of the people have already voted.
Okay, I'll end the poll now. That's a damn obvious.
Yeah. It's good that, as I said, this is one of the most overrated number that people do talk about, and all of us have actually got the right answer. So NAV is the net asset value of the funds that are being that the fund is holding. So it has nothing to do with the price. So if a fund is available at an NAV of 10 rupees and another fund is available at the NAV of 200 rupees, it doesn't really matter. What it is signifying is the net asset value of that fund which it is holding as compared to the units which have been issued. And there's nothing to do with the price or valuation of that fund. A 10 rupee fund does not mean it is cheaper, and a 200 rupee NAV fund does not mean it is expensive. Great. So with that out of our way, and since we have such a matured audience, I'm not going to spend too much time on this, and then we'll quickly jump to reading a fact sheet. But what I've done is that there are so many types of mutual funds, and how do we really understand what are those different types of mutual funds? So I've created this 6 so-called lenses in which you can differentiate various kind of mutual funds, right? So first one, which probably all of us know, is based on the underlying asset. So like I just mentioned, that mutual fund is not an asset class in itself. It is a vehicle through which we can have investments in various asset classes. So you have equity mutual funds where the money is invested in equities or shares. Then you have debt mutual fund where the money is invested in fixed income. Likewise, you have gold mutual fund where the money is invested in physical gold. And for the combination of all of these, you have hybrid mutual fund. This is the first distinction of a mutual fund. If you have to really understand what kind of mutual fund it is, you should first know that what asset class it is investing into. Now, even in asset class, what SEBI did in 2018 was that it created various categories to really classify as to what kind of, even within that asset class, what kind of mutual funds, what kind of assets were being held. So in equities, if I'm not mistaken, there are about 16 odd categories, and in debt the number of categories is even higher. So there is a large cap mutual fund, then there is a mid cap mutual fund, there is a small cap mutual fund, then there is sectoral mutual fund. So what are these basic categories? As the name suggests, a large cap mutual fund is a fund which invests into top 100 companies in India in terms of market capitalization. So again, this definition has been given by SEBI, and 80% of the money which is invested in these funds has to be invested in these top 100 companies. Similarly, mid-cap companies is the companies which are ranked from 101 to 250th. So first 100 becomes the large cap, next 150 companies become mid-cap, and all the companies after those 250 companies are small cap companies. If the fund is investing into a particular sector, so suppose if it is a fund which is investing only in banking sector, then it becomes a banking fund. If it is investing in technology sector, then it becomes a technology fund. These days, pharma is very, very popular. So if it is investing in pharma, then it becomes a pharma fund. So there are various funds which are investing into various sectors. And again, these are all categorized. So you have a category for international funds. Likewise, there are various categories only for equities. Similarly, for debt, again, there are a lot of categories. Just to give you a sense, so one is a fund which is investing into short-term debt. So basically, those funds are investing into papers which are going to be maturing in short term. So there can be fund which can be investing into papers anywhere between 1 month to 2 to 3 years. So that is a typical, say maybe a year would be a short term, 1 to 3 year would be a medium term, and then longer than 3 to 4 years is a long term debt paper. Similarly, there are funds which are investing only into government papers, and they're called gilt funds. And then there might be funds which are investing only into corporate papers, so they're called corporate bond funds. So again, like this, there are various categories in which you can be investing when it comes to debt mutual fund. So first we know what asset class it is, and then within asset class, we know which category this fund is investing into. Then we can also distinguish mutual funds on the basis of transactions that we can do in that particular scheme. So one most popular and most common form of mutual fund investment is an open-ended scheme. So what does an open-ended scheme say? That you can invest and exit at any point in time. There might be exit loads which may be applicable, but your money is not locked in. You can enter at any point in time. You can exit at any point in time. These are the most popular and most common categories in which we invest. Then, as the name suggests, then there is close-ended scheme. What happens in close-ended schemes is that the window for investment is available only during the new fund offer or the NFO it is being offered. It can last from anywhere between 7 days to 15 days, and whatever money is invested in those period only is the final investment in that amount. So no new investor can come in after the new fund offer is complete, and generally there is a lock-in period. Investors cannot exit until the maturity of the close-ended scheme. These were very popular earlier. Due to some regulatory changes, these have become extremely rare now. A lot of funds don't come out with a close-ended fund. Fixed maturity plan, if you would have invested, is a most popular form of close-ended scheme, where money was invested for investments were taken for a very short period, and then money was logged in for 3 years or 5 years, 1 to 3 years, depending on the need of the investor, and because it gave indexation benefits. Third is ETF, again, which is getting a lot of popularity. ETF is exchange traded fund, and what happens in ETF is that, unlike other mutual funds, where the counterparty for your transaction is the fund house itself. So when you are buying mutual fund units, you're buying it from the fund house, and when you are redeeming or selling your units, you are selling it to the fund house. So for you to transact, the counterparty is mutual fund house itself. But in ETF, the units are listed on the stock exchange. So the counterparty to your transaction can be another investor. So for example, if you want to sell a mutual fund unit, I can be a buyer to it, and those units are traded on exchange, and that is why it is called exchange traded fund. In exchange traded fund, there are two things. One is the NAV of the fund, which is published by the fund house every end of the day, every day. But ongoingly, there is price fluctuation to it as well, which is impacted by the demand and supply. So ETF is gaining immense popularity in our country, but we feel it is not a very advisable thing for an individual investor to do. It is good for big institutional investors, like EPFO and treasuries of big banks and companies, to have the exposure in equity for them. Lastly, ELSS, which is equity linked savings scheme. ELSS is also a form of open-ended scheme. The only difference is, because it gives you tax benefit, there is a 3-year lock-in. So you can invest at any point in time, and after the lock-in, you can exit at any point in time, but you have to stay invested for 3 years. After 3 years, unlike closed-ended fund, there is no maturity as such. The units are just available for redemption. So you might choose to redeem, you might choose to continue. That's completely your option. But then units are locked in for 3 years. So basically, on the way you do a transaction, you can distinguish between different kind of mutual funds. Fourth is how income is distributed. So when you invest in a mutual fund, the mutual fund value of those assets that you invested into will grow over a period of time. So there are two ways in which that income can be distributed. One is the growth option, where nothing is happening. Whatever is the growth or whatever the profit is booked, again it is reinvested in the fund, and that's how the value of your units keeps on growing. The number of units will remain same, and the value of units will keep on growing. So the NAV will keep on growing. In dividend option, the income is distributed to you. So the income is not reinvested in the fund, and it is distributed to you, and that is why you get the dividend money to you in tranches every year, or whatever is the frequency at which the fund is declaring the dividend. And the value of the units don't appreciate as much as it is appreciating in growth option, because in growth option you can see the power of compounding. Just to give you a quick preference, we would say that don't invest in dividend mutual funds, especially now, because the taxes are not in your favor. If you already have an existing fund in which you have a dividend option, we would strongly suggest that you switch from a dividend option to a growth option. Then there is you can distinguish mutual fund between based on the intermediary engagement. So there is something called as a regular plan where you invest through an intermediary. Um, Intermediary gets paid by the fund house itself uh, for your engagement, and that's how intermediaries earn from when you invest through them. Then there is something called as a direct plan where you feel that you are aware enough to invest in mutual funds yourself. You can choose to have a direct plan. So it's basically a no help plan where you invest directly with the fund house. And because you are not taking help of any intermediary or any advisor, you save in commissions, which eventually results in lesser expenses and higher returns to you. So one thing you have to remember is that if you are dealing through a bank or a broking house, some people have this confusion. Just to clarify on the name, like ICICI Direct. ICICI Direct is a broking house. So if you are investing through a broking house, it is an intermediary. So you will eventually end up investing in a regular plan. Only if you, so whether it is if you're investing through a bank in a mutual fund, or you're investing through a broking house or any other distributor, you will end up investing in a regular plan. Only if you choose to directly deal with the fund house, you will be able to invest in a direct plan. And lastly, based on how the fund is managed by the fund manager, there is something called as an active fund and a passive fund. In active fund, the fund manager is taking all the calls. Like I said, if it is a large cap fund, uh, the fund manager has the option to invest 80% of the corpus, minimum 80% of the corpus in any of these top 100 companies. So he might choose to invest wherever he feels comfortable or wherever he feels that the will work best for the investor. Uh, but if it is a passive fund, the role of the manager is very, very limited. What passive fund does is that it blindly follows the index for which it is targeted to. So suppose if it is a Nifty fund, Nifty index fund, it is a passive fund, and we invest into those same 50 companies which are part of the Nifty in the same weightage. So say for example, HDFC Twins have a weightage of around 17-18% in index Nifty. So the passive fund will have the similar weightage, and then they're rebalanced on a regular basis. But the fund manager is not taking any calls in this passive fund. It's basically just replicating the index. So if any particular stocks goes out of index or comes back into the index or new stock added, so the passive fund will accordingly make the changes. In active fund, the fund manager is taking the call every time, and it depends on him how much allocation he wants to give to a particular stock or how many stocks he wants to hold in his portfolio. So now so I just wanted to quickly, give a background of what are different type of mutual fund. Now let's get into fact sheet, and let me start with I think I'll have to start a new window. So let me just stop sharing this. So to give you a live demo, can you see my Google Chrome sheet? I think you can't, right?
No, we are not able to, Saurabh.
Okay, just a second. Just a second. I see some, there are some questions in Q&A. I think we'll take the Q&A, at the end of the session. I'll just switch off my notifications because disturbing a bit. Yeah. So, this is how and I have not downloaded the sheet on purpose so that all of you can really understand and look at how do we really look at those fact sheets. So this is, if you want to read a fact sheet of any particular fund house, you will have to just search for it on Google, and most probably Google will take you on the page on which you are able to download the fact sheet. These fact sheets are in PDF forms, and they are huge number of documents into it. So I'll just show it to you once it opens. So this page opened and we clicked on fact sheet. Now we have a fact sheet for the month of July, for the last one which ended, and we're going to try and understand this fact sheet. So as you can see, it is an 88-page document. Yeah, you can see that, right? So obviously don't get bothered by number of pages. All you have to do is to find the fund on which you want to read the fact sheet. So what fund houses do is that they give their view on markets, what is their commentary on how things have moved, what has happened in indices. So it's a good way to understand what the fund house is really thinking and what their views are. And because it is in print, generally you will find really good stuff to know and understand why a fund manager think in a particular way. And it includes macroeconomy, it includes indices, it includes things about domestic situation as well as international situation. So I'm not going to talk about all this. These are all things that you can look at. And I'm just scrolling so that you understand how comprehensively these guys work, and so much work goes behind creating a fact sheet every month. Now here, like I mentioned, you will see mutual fund schemes for different asset classes, and within those asset classes for different categories. So these are the categories which are mentioned. I hope you can see my cursor, right? So every fund house is allowed to maintain only one fund in each category. So you cannot have uh, multiple funds for same category, right? So that is what SEBI has kind of regulated and made the changes in 2018, which made things very, very simple for us as an investor. So, like you can see here, and by the way, this is not a recommendation. It's just that the fact sheet of ICICI is fairly colorful and easy to understand. That's why I've just chosen it. We could have chosen any other fund house or any other scheme for that matter, but it's just because it's easier and very popular name, we've chosen this. So these are the various categories, like I mentioned. There is a large cap fund, large and mid cap category. There's a multi cap category. Then there is a value fund category, ELSS, so and so forth. And these are the categories in hybrid fund where it is a mixture of combination of equity and debt and maybe sometimes even gold. Then these are debt categories that they have. So what we are going to do is that we're just going to talk about one fund. So let's because it's a flagship fund for ICICI, let's try and understand how do we read a fact sheet for ICICI Prudential Blue Chip Fund. So it's right on the next page, on page number 11. Wow, they have changed the format for this month. It was completely different for last month. So I think it'll be good for us. I'll explore with you. So this is the fact sheet or one pager. So this is only on one page. So the whole point of reading a fact sheet is that they are trying to concise and put everything on one page for you to understand as to how mutual fund work. I think I'll just increase the size of this sheet so that people are able to view it even better. Jinan, let me know if there is anything on chat which is not working for any participant.
No, I think this is good. This is good.
So we'll come to as to what do we need to look at mutual funds. What are the things that we should really note when we are looking at a fact sheet? Let me just first summarize with you what kind of information is already available. Okay. So this is the style box. You will find this style box in equity fund as well as in debt funds. So basically what this style box does is that it simplifies in a graphical manner for you to understand which category of fund this is. So on the y-axis, you have value, blend, and growth. These are various styles of equity investing. When you're investing in a high growth company, it is called growth. When you're investing in a company which has a lot of value and it is kind of available at a discount, it is called a value investing. So you can have value funds which are purely having value stocks as the underlying, and then there are growth. And then there could be a blend of both. So as you can see that there is some spilling which is happening. That means it is not a pure growth fund. Some portion of it is also invested in value stocks. There is a blend of it. It is not a pure growth fund. Predominantly it's a growth fund, but some part of it is invested into blend, value stocks also. Similarly, like I said, that 80% of the money has to go in large cap. Again, you can see that there is a spill in the mid cap. It is not a pure large cap. Some money is invested into the mid cap also. So it gives a very nice, demonstration of where the fund is actually investing into. This is the performance as on 31st July. And you can see what is the performance on last 1 year, 3 year, 5 year basis. So as you can see, first row is the scheme. So what is the investment return on the scheme last 1 year? It is a negative return of minus 1.03, which means that if you would have invested 10,000 rupees a year back, which is on 1st August 2019, then the value of your investment would have been 9,897. This is what it signifies. But if that same money, so this fund is following two benchmarks. One is the primary benchmark, which is Nifty 100. Like I said, the top 100 companies comprise of the large cap companies. So that is their main benchmark. If that benchmark has returned a positive returns, so it would have been plus 1.10 and 10,000 would have become 10,110. And if you would have invested in Nifty 50 TRI, which is the total return index, which assumes that the dividends are also invested back, in that the return has been positive 0.68. So 10,000 would have become 10,068 rupees. Now, as you can clearly see, what do you mean by overperformance or underperformance? This means that the fund has underperformed these benchmarks, right? So if you would have just done nothing and invested in a plain benchmark or a passive fund, you would have done better as compared to the scheme. Now, you don't have to take any decisions based on this. We'll discuss on how we can use this, but this is the first thing to understand whether your fund is outperforming the benchmark or is it underperforming the benchmark. Now, 1 year is not a very good period. In fact, just looking at this is just one data point. So this is not good. So we'll try and go to a morning research website where we'll see something called as rolling returns, and it'll be easier for you to understand. But let's first understand what these figures are. So similarly, on a 3 year basis, the fund is given 2.19, Nifty 100 is given 3.76, Nifty 50 is given 4.46. And on a 5 year basis, again, it has underperformed. Scheme has given 5.96, Nifty 100 is given 6.70, and Nifty 50 is given 6.66. And you can see that the amount is lesser as compared to both the benchmarks. But if you look at from inception, now when did the fund incept, we'll see that as well. It has significantly outperformed both these indices. So 10,000 invested at 12% would have grown to 40,000 rupees, almost four times the investment. But in benchmarks, the return was about 8 odd percent. Can we infer that the active fund will beat the benchmark in the long term? Not necessarily. Don't infer that. Again, I'm saying that first let's try and understand what these numbers mean. So this is the first part of it. These are some uh, statutory announcements that they have to make. So you can always read these notes. Again, these also provide valuable insights into how the funds work. So this is the inception date, 23rd May 2008. So these returns of 12.13 are if someone would have invested on this particular date. Okay. So now let's go to this second part of the fact sheet. Let's try and understand what these numbers are. Okay, some of these are operational numbers which help you understand, how do you transact into these businesses, into these schemes, and some of them are qualitative or details which can help you in research to find which funds are would suit your need the most. So starting from this column, who are the fund managers in these schemes? So this is co-managed by two fund managers, Anish Tawakle and Rajat Chandak. It also mentions their overall experience and since when they have been managing this fund. So Mr. Anish has been managing this fund since September 2018, while Mr. Rajat has been managing this fund since July of 2017. What is the indicative investment horizon? So as per SEBI regulation and as per ICICI's thinking, if you're investing in an equity fund, your investment horizon should at least be more than 5 years. Like I said, that there is no lock-in, but if you're investing with an horizon for less than 5 years, probably this is not an appropriate fund. Then this gives the mandatory details of NAV. Like I said, it should completely be ignored, but just to understand. So because we just spoke about what are different types of mutual funds, this is growth option, where the money is reinvested. For the same scheme, this is the dividend option. Here you can see that NAV is lesser because the money is not reinvested. The growth is not reinvested. It is given back to the investor in form of dividend. The NAV is lesser than the growth option. Similarly, for the same options, these are regular plans. If you are doing a direct plans, then the NAV is higher, which signifies that the returns have been higher for an investor. So in direct plan, the NAV is 43.06, while in dividend option, the NAV is 29.43. Now this 29.43 and 18.65, don't confuse that this fund has significantly given better return in direct plan option. It might be because the dividend frequency in growth option and direct option can be different. So what this means is that the fund has been given dividends more regularly in growth option, while in dividend option they have not given dividends very, very frequently. This is the monthly average AUM. So what was the average AUM over the period of month of July, which is 23,964. The closing AUM, that means as on particular date of 31st July, was 24,000 crores. So as you can see, this single fund itself is managing about 24,000 crores of rupees of investors' money. Another operational thing is that you can just start investing with only 100 rupees. So minimum amount for fresh subscription is 100 rupees. And if you want to top up your investment, you can even top up with only 100 rupees. This is the exit load and redemption switch options. What happens if you switch the money? So like now there is no concept of entry load, so funds don't even mention it. So when you invest, obviously there is no load or charge that you have to pay. But if you are exiting an investment, and here they mention their conditions, that if you are exiting up to 1 year from allotment, 1% of the applicable NAV will be charged as exit load. But if you are exiting after 1 year, then there is no exit load. And lastly, over here, as you can see that the expense ratio in direct plan is 1.73% and in direct plan it is 1.08. Like I mentioned that the direct plan expense will be always lesser because there is no intermediary involved, and the option in regular plan or other than direct will be 1.73, which is higher than the direct plan. Now, once you've done this, then you come to where your money is actually invested, right? So what we can see here is the number of stocks and sectors in which this fund has invested into. These dots, as you can see, are signifying the top 10 holdings in this fund, right? They can be from different sectors. So they have sorted it in alphabetical order of the sectors. So they start with auto ancillaries, banks, cement. These are all various sectors in which the company is invested into. Obviously, you can go in detail as to understand, and they give you the weightage. So 5.35% signifies that out of this 24,000 crores that the fund is managing, 5% of the money is invested in auto sector. 18% of the money is invested in banks. 1.21% is invested into cement, so on and so forth. And within the sector also you can see the breakup of the companies. So it is as transparent as it can get. There is nothing hidden. Everything is declared on a monthly basis to the investor. So you exactly know that in your portfolio in this particular scheme, 2% of the value of your investment is invested into a company called Maruti Suzuki. Similarly, 1.75% is invested into TVS Motor. So every single rupee that has been invested, the percentage of it is given here. Now, another interesting thing is that 93% of the money is in equity. What does it mean is that uh, there is some money which is lying in short-term debt, which is 4.82, and that is there is some money in government securities, and they've given this separate qualification. This is equity of less than 1% of copper. So this 9.41%, we don't know which company it is invested into. Again, that if you want, we can get. So 4.82 is in short-term debt and net current assets. So this gives you the 100% declaration of where your money is actually invested into. They've also given it in form of graph for you to understand what are the top 10 sectors that this scheme is invested into. So 18% is in banks, software, petroleum products, consumer non-durable, finance, and so on and so forth. Now, this is, like I said, an active fund manager has the flexibility of taking that call, and it will be completely different if you see in a passive fund. These are basically quantitative indicators. We will not, this is a webinar in itself, so we are not going to talk about what this means, but these are various indicators for a person who's researching on mutual fund to understand, how this fund has performed in the past in terms of these various indicators. So PE is price to earning ratio, price to book ratio, what is the average dividend yield on the stocks that this fund is holding, what is the turnover ratio, that means how much selling and buying is happening in this portfolio. When it says 0.14 times, that means only 14% of the portfolio is traded in the whole year. That means the fund is maintaining a really low churn, so they're not buying and selling too frequently. This is the standard deviation. So again, it is a very complex or something to look. It just basically on a very layman language term, it basically measures the deviation from the average return. So how much more or less you can get from the average return is what standard deviation is. Higher the standard deviation means the higher the volatility, and which is higher the risk. This is Sharpe ratio, which signifies the return that you are generating for every unit of additional risk that the fund is taken. And this is the portfolio beta. That means how will it perform vis-a-vis the benchmark. We are not talking about these ratios today, but these are all given in the fact sheet. This is the riskometer. It basically tells this product is suitable for what kind of person, what is the risk in this particular scheme. And again, this is as mandated by SEBI, and every fund house and every scheme will publish this. So basically, this is what you get when you when you read the fact sheet. This data is available month on month. Now, what I would want to do quickly is to take you on a. Now, obviously, it becomes very cumbersome for all of us to go on individual companies' website, download the fact sheet, study it individually one by one, and it becomes very difficult to compare. And this job is done significantly easier by various websites who help in researching about mutual funds. So what I'm going to do quickly, and to with that I will complete this webinar, is to give you a sense of this. Basically, this search is not very, yeah. So we'll choose this ICICI Prudential Blue Chip Growth option. And what this does is that it gives you a lot more information, and then it becomes easier for you to compare, and it is much more concise and much more consumable. So again, this is a NAV. Because it's a US based website, US based company, they still refer to millions and billions. So 242 billion is, like I mentioned, 24,000 crores. This is the expense ratio. This is, here it says that it is more into blend, and it can differ depending on what is the definition that uh, the website is giving. But all these informations are available here. This is how you can see the long-term performance of the fund, as to how the fund has performed over a period of time. And if you log in, there are a lot of things that you can do. As it shows, login to show interactive chart. If you log in, there are a lot of things that you can do. I'm not going into doing that. This shows how much is in non-US equity, because the money is invested only in India. I'm not this. See, this is very interesting. What this does is that it gives you a manager timeline. So here it is saying that three fund managers are managing it. There is Priyanka Khandelwal, Mr. Rajak Chandak, and Anish Tawakle. But it also shows that since how long these fund managers are there, and who was managing these funds before them. So as you can see, this fund from 2012 till 2016 was managed by Mr. Manish Gunwani. Just before he left, he handed over it to Mr. Rajat and Ms. Priyanka. And then it was eventually Mr. Shankaran Naren stepped in. And then he moved out and Mr. Anish joined in. So you can see how many fund management changes have been happening in this fund house, in this particular scheme. It clearly becomes visible when you look at it from this perspective. Again, what this does is that it gives you much more better analysis of the stocks. So this gives you the number of stock that this company is holding, 63. What are the number of bond holdings? What are other holdings? How much money is there in the top 10 stocks? This shows that there is a turnover of 87%. So I am not sure why there is a huge difference. I'll just try. It's a revelation for me as well, and I'll try and figure out why there is such a huge difference of 14% and 87%. And then this gives you, what is happening in those stocks. Um, when was it first bought? How the stock performed? What is the actual value? Everything is mentioned here, and you can see about all the holdings of what this fund. So this gives you even much more richer experience for you to understand how the stocks and in your funds have been doing, and what they've been doing in your scheme. So like here you can see that HDFC Bank has gone down by 6% in last 1 year, and they have reduced their allocation by 5%. They've reduced their allocation towards HDFC Bank. So ICICI Blue Chip is basically selling or reducing the holding in HDFC Bank. So I mean, there is too much to it. There is you can look at more detailed portfolio. Then there is performance. So I'm not going into that. Let me just come back to the presentation and sum it up for you before we conclude. Just a second, please. So there's just 6 minutes left. You can't see my screen, right?
No, we are not able to.
Just a second, please.
Yeah, you can see your screen now.
Right. Awesome. So, um, you know, let's just sum it up with what we saw. So when you look in a fact sheet, when you look at the performance, don't look performance in a silo. Compare it with the benchmark and compare it with peers. No performance single-handedly is good. You don't know if 12% is good or bad. You would know only if you compare it with the benchmark. So if you want to know whether your fund has performed well or not, it's better to always compare it with the benchmark that it is benchmarking itself against. Portfolio holding, this is very, very subjective. We feel that a fund should not be holding more than 50 stocks, because if there are too many stocks, it basically means that the fund is buying the whole market, and it's not very sure that if the fund will be able to really deliver that alpha which for which we are opting for an active fund management. Again, this is very, very subjective, not necessarily always true, but this is what our preference is. The expense ratio, it is not very, very important thing. We saw the expense ratio in the fact sheet, but it all because ultimately the returns that you make are net of those expenses. So if a fund with a 2% expense is going to give you say 15% return, and a fund with say 1% expense is going to give you 12% return, doesn't mean it will not make sense to go for a lower expense fund. But it always helps to compare it with peers, that if you're investing in, suppose when you're choosing a too large cap fund, it would be better to choose a fund with a lower expense ratio. Uh, Again, for AUM, this is again a very, very subjective thing. We feel that a very sweet spot for a multi-cap kind of fund is if the fund AUM is around 5,000 crores. When the fund size goes just much higher than that, like we saw 24-25,000 crores, I think it is a huge fund, and then the number of stocks also increase, and then it becomes difficult. It might become difficult for the fund manager to keep a complete control over the portfolio. In debt, it works the other way around. If the fund size is comparatively bigger, it is much more helpful, because then you know that the fund has the muscle to then muscle power to kind of negotiate with the issuer and get better deals. So we feel that again the sweet spot is around 10,000 crore. In liquid funds, higher the AUM, the better it is what we feel. When you're looking at category, look at the category from whether it matches your risk profile. So obviously we know that large cap funds as a category would have lower risk as compared to a mid cap or a small cap fund. So look at category before choosing the fund. And even when you want to diversify, obviously you look at category. So it will not make sense to buy two funds from the same category. That means you are not essentially diversified yourself. Ultimately, you're investing in the same, the underlying companies will be the same in both the large cap funds. Uh, Exit load doesn't really matter, because like we discussed that the investment horizon should be more than 5 years. But obviously the lower the exit load, it is better. I think the standard exit load that market follows as a practice is 1% exit load if the investments are held for less than 1 year. When you look at the fund manager, look for the stability of the fund manager. So the longer the fund manager has stayed with the fund, better it is. If you're comparing two funds, and I see that one fund manager has recently joined, and then there is a fund manager who has been there for quite some time, obviously I will choose the fund with the stable fund management team. We didn't look at the fact sheet of a debt fund, but in debt, when you're investing in debt fund, there's something called as a rating profile, which gives you the credit rating of the papers in which that scheme is invested into. Generally, not generally. So how the rating is being done is that triple A is considered to be the safest. So depending again what your risk profile is, you would want to invest in that particular kind of scheme. But we feel that it does not really make sense to take a credit risk in debt fund for simple 1 or 2% extra additional returns. So try and invest in fund which has the highest allocation or almost 100% allocation to AAA papers. So this rating profile also you can see in the fact sheet. Last thing, it is important to understand which benchmark the scheme is following. So at times you will see that scheme A has beaten the benchmark and scheme B has not beaten the benchmark. But when you look at more closely, you might find out both of them are following a separate, different benchmarks. So when you're comparing schemes, just look at it that are they following the same benchmark? Like we saw in Nifty, in ICICI Blue Chip, that their primary benchmark was Nifty 100 and they had an additional benchmark. So when you're comparing different schemes with the benchmark, ensure that it is compared with the same benchmark. So that's it from my side. Jinay, we can quickly run poll 3 and then we'll also run the poll 4 for the feedback.
Surely, I'll just do that. So here comes up poll 3.
So this is the real test of how much value did you get? What do you kind of question for you to understand. So if you want to ensure that there is a diversification in your investments, and you have to choose, you want to diversify in 2 funds. How will you diversify? Will you diversify by investing in 2 different categories, or will you diversify by investing into funds of 2 different companies? So I think we have a really smart audience today.
Incredibly smart audience.
Sorry?
Incredibly smart audience. I completely agree with you.
Yeah, so we can end the poll now.
Let's do it.
So overwhelmingly 95% of you are correct that if you really want to diversify, look at diversifying by investing in different categories. If you're investing in scheme of a particular AMC and another scheme of a particular AMC, it doesn't necessarily guarantee that it is diversification. Because if you're investing in the same category, ultimately your underlying assets would be same, as I mentioned during my presentation. 5% of you feel that by investing in different companies will result in diversification. It might happen, but it is not necessarily true, because if you're investing in the same category, there's no diversification. So with that, I would end my presentation and I'm open for Q&A. I'll just stop sharing my screen.
So what I'll do is, in the meantime, I'll keep the feedback open as we dive into Q&A. For any questions that you have, you can always use the Q&A box and we'll take up with Saurabh for that. Okay. So this is for the feedback.
Your feedback to us, you can also put in chat if there is some specific comment that you would have. But the feedback really helps us in understanding if we are really able to provide value to you. Please be generous and give your feedback.
Okay, Saurabh. So till the time we are getting more feedbacks, this first one. So there's one question that I really would want to ask you is, so so the last point that we ended our presentation with was benchmark. In that extent, in that thing, what about having your own benchmark? Like there was Nifty 100, there was Nifty 50. What about if I want I want to compare it with Nifty 500, because there are times when a mutual fund may have certain stocks in the portfolio which may not comprise of Nifty 100 at that point in time. So how do you see benchmark in that light?
So I think that was a problem that earlier a lot of investors were facing, and that's what SEBI solved in 2018 by doing the categorization, where they defined what is a large cap. So up until 2018, it might really surprise some of you that up until 2018, there was no standard definition of what is a large cap, a mid cap, and a small cap. So only in 2018, SEBI defined top 100 companies as large cap, next 150 companies as mid cap, and companies after that as small cap. And they said that if you are a large cap fund, you can't deviate much from the intention of the fund, and 80% of the money has to go in large cap stocks. So you can be sure that if it is a large cap fund, majority of the money is in large cap, and then it can be easily compared to the benchmark. So I mean, then there is no really need to understand what is the average market cap of the stocks that the fund is holding and so on and so forth. Now it is pretty much standardized. Did I answer you, or is there anything else?
No, no. Yeah, I think that was good enough. I mean, there was a long enough answer for that. Going to the Q&A box. So Himlata is asking, like continuing on a benchmark part is, she's asking, can fund houses change the benchmark for any fund regularly?
I mean, they would not want to do it. They can change it. They don't do it regularly, but they have the power to change. Like we saw that in ICC, they had two benchmarks. They can always switch Nifty to their primary benchmarks. They can do it, but they would not want to do it very, very frequently.
Oh. So next set of questions are from Abhijit Vaidya. I think he's got a lot of questions. And so the first question that he's asked is, can you explain why you feel ETF is not suitable for small investors, but are more suitable to treasury and big investors? Why for ETF?
Sure. So I'll just end this poll. Is that okay? Because I think it's already 3 minutes.
Yeah.
90% people have voted, but I think it should be.
I'll end the poll. Okay.
So thanks a lot for your great feedback. Yeah. So see, ETF. See, the most of the ETFs that are available in the market, which are very, very popular, are nothing but a version of passive index funds. So it's not that those ETF opportunities are not available for you to invest in a normal frame of investing. There are a very few set of ETFs which are very, very rare and not a lot of people are investing, which is called factor-based indices, which not a lot of people are investing any which ways into. And sooner or later, I believe that even those funds will come in those factor-based indices will also come in the normal mutual fund form. So like I said, that when you are not investing in ETF doesn't mean that you don't have the opportunity to invest in the same index fund. Now, a lot of people are investing in ETF because the expenses are lower as compared to a normal fund, is what is believed into. But that's not true, because what happens is that when you're investing in an ETF, the difference between the expenses is not very, very high, especially if you compare direct plans with ETF. Second is that to buy an ETF, if you don't have already, you will have to open a demat account and a broking account, and also pay a brokerage every time you do a transaction. So that is the second disadvantage. And thirdly, and most importantly, see, what happens is that you are trying to save by investing in ETF. Like I said, the only advantage is saving on expense. So that is why I said that it makes sense for large investors or corporations where they are investing thousands of crores of rupees. Even if you're investing 1 or 2 crores, I would say, will not really make a difference, because you not spend that much. And why is that? Because say if the difference is say 10 bips. So this 10 bips of difference is available to you if you stay invested for the whole 1 year. The difference between a normal passive fund and an ETF, right? Now, during the day, markets are so volatile that the comfort in mutual fund is that you just get the closing NAV, right? So you don't have to really worry at what time of the day you are investing into. But in ETF, the market is so volatile. Even if you want to invest in the last 5-10 minutes of the index, you might not be sure as to what ultimate price that you will pay. And that difference of 10 bips, it can work for you, it can work against you as well. But I mean, just for the difference of 10 bips, why would I want to open a separate demat account, track my mutual fund separately in a normal course and then ETFs separately? Only from that perspective, I think ETF doesn't really work. So in developed economies, there are dedicated dealers which are appointed by brokers who deal specially for you to, when they're investing in ETFs. I think we are yet to evolve to that stage specifically for retail investors.
Correct. So what you're saying is we are in a very primary stages for ETF to actually come in, liquidity to enter that space, and where we get advantage.
Correct. And plus, SEBI itself has been so pro investor that the expense in normal fund itself is so less and it is comparable with ETF, that ETF here in India doesn't really give you that edge that it might be giving in foreign countries.
So again, Abhijit is asking on the grounds, what about gold then? Gold ETF, funds that invest in gold, or some precious, metal companies or SGBs.
Yeah, so for every gold ETF, there is a gold fund. So it is a fund of fund which ultimately invests into that gold ETF. So you can always invest into the gold fund. Again, one more disadvantage of ETF is that you can't really do an SIP in ETF. Here, because it is a fund where you can sign a normal mandate, you can do a normal SIP in those kind of funds. So again, it does not make sense to invest in a gold ETF in that sense. It's better to invest in the fund of fund or in a fund form.
Okay. Even sovereign gold bonds are a good way to invest, right?
Obviously, I mean, sovereign gold bond is not the purview of our discussion today, but sovereign gold bond, the biggest advantage is that every other form of gold investment that you do, you have a negative cash flow because you ultimately spend on either security or maintenance of the investment that you're doing. Even if you're investing in a mutual fund, there is some expense that you're paying for investing in that fund. Sovereign gold bond, on the other hand, pays you to invest. So you earn an additional 2.5% per annum for investing in gold. And plus, if you hold it to maturity, the capital gains are tax free. So I think it's a big advantage if you really want to stay invested in gold for a long period of time.
Correct. I mean, it's a steal deal. So I'll come to so moving away from ETF and all the other spaces, we come back to the fact sheet. So Abhijit has asked his last question on third question on fact sheet is how to use fact sheet for investing or divesting decisions, and how to use it for SIP investment decisions. I mean,
so see, when you're investing in mutual fund, it doesn't really matter when you choose a scheme basis of whether it is for a lump sum or an SIP. I mean, ultimately, you choose if the fund is fundamentally strong and you want to stay invested in that scheme for a long period of time. So when you're looking at a fund, when you're looking at a category, so suppose if I want to invest in a large cap fund, it doesn't matter whether I want to invest on a lump sum basis or on a SIP basis. Uh, because that's just a transaction system that I'm doing. I'm if ultimately my money is going to be held in the same set of stocks, so I just have to understand the fundamentals of that particular scheme. As far as how to use the fact sheet is what we try to sum up. That what should be the sweet spot of AUM, how long is the tenure of the fund manager, is the fund consistently beating its benchmark, what is the expense ratio. So if you are able to look at these things and compare it with other fund in the same category, I think it will be much easier for you to decide as to what scheme or fund house will work for you.
true, very true. So Vinod is asking again, I mean, on the fact sheet front, what are the key makers in fact sheets to help in making decision for exit or return? One cannot accept that the history shall repeat it and give you the same returns. So,
which is very true, and that is why we are saying that you should constantly keep on monitoring your investments. When I say constantly, doesn't mean that you have to do it on a monthly basis, but even on 5-6 month basis, if you can see that there is something called as a rolling return. So if your fund has been beating the benchmark on a rolling return basis, again, has the fund size grown really out of proportion? If it is too big, has the fund manager been churning or fund managers moving in and out? So these are, I think, the factors. And mostly what we see is that most of the fund people exit investments looking at comparing it with other schemes. So we have seen this very commonly, that a fund investor sees 3 schemes in his portfolio, and if he has to sell any scheme, he would by default sell the scheme which is the lowest performer at that point in time. So that should not be the real strategy for exiting a scheme. If you can really understand what that category was, is that a different category from other holdings, and if you are able to then quantify these details like the age of the fund manager, how long he's been in that fund, the size of the fund, the number of stocks that it has been holding. I think that will kind of give you more clarity as to whether you want to really retain that fund, or if you have any other option where you want to exit and stay, want to invest, then you can compare as to what advantage you see in the next fund over this existing fund, and then you can maybe take a decision to exit.
So just adding to it, the exiting is a webinar in itself. When we're talking about exiting, is a huge content, exiting an investment. We have one coming up. You'll be notified in some couple of days when we're talking about how to exit an investment. So hopefully, at that point in time, a lot of your questions will get sorted out. I'll hope to see you that time. Amit Gajaria is asking a question, that is in newspapers, they tend to see a lot of these best performing stocks. So best performing funds, sorry, not stocks, best performing funds. So is it just okay to just plainly invest into them, rather than going through so much? Is what he's asking.
Yeah, I mean, I wish it was that easy. I mean, otherwise, there was no need for this webinar, right? I mean, I could have just told you to read the newspaper, I mean, even these websites that we saw, Morningstar and Value Research and all those websites, they also have their famous star ratings, and you can look at those and invest. But what happens is that, you don't know, or you don't understand. I mean, hardly would people really read and notice as to why this particular fund has been given a 5-star rating. And what will happen? So if you invest on a 5-star basis, what happens? What do you do when these fund houses downgrade them to a 4-star or 3-star fund, right? So you can't keep churning your portfolio just on the basis of the stars which are given by these research agencies. So I think it's better to understand as to why you're investing. I mean, if you want to do it on your own, you will have to do the hard work. Otherwise, obviously, you can appoint an advisor and you can ask these questions to him as to why he's choosing a particular fund, what is his thought process behind it, and what is it that he is following as a process to choose a particular scheme, and then keep on rechecking with him that is he standing by that process, or is he deviating from that process of choosing a particular scheme. But if you want to invest on your own in a direct option, I mean, it should not be, it is not as easy to just read the publication and then decide as to what the best fund could be. Because if you keep on churning on basis of that, it will be very difficult to create money on the long term.
Okay. So Arpan is asking, on a similar, not so similar, but similar notice. Can a purchase price of a stock by the mutual fund be available in a fact sheet?
Not available, but there are certain research guys who do the hard work. They kind of, try to understand what is the new amount that has been invested, and they try to find out what are the number of stocks that are there. So they try to find the average price at which the fund uh, uh, has bought that particular stock, but there is no clear way to find out as to what exactly was the purchase price or the average purchase price in that month for that particular stock. And see, I think if I understand where you're coming from, is trying to understand that, if that particular fund has bought a stock at this price, it would be better or easier for me to buy that stock at a lower or the same price. Again, I would say it doesn't work that way. The fund would have their own priorities and understanding, and when you are maintaining your own portfolio of your own stocks, why would you want to follow a fund and not invest into? I mean, if you know that the fund house is doing that work, you any which ways rely on the research capability of the fund house. You feel that if a fund house is picking up a particular stock and you are okay with that, why just not invest into it, and why duplicate a portfolio and take all the hard work and invest all the resources and time to maintain that portfolio. So That's just an extension to your question, but the answer is that the fact sheet does not give you the exact price at which the stocks were bought.
Yeah, I mean, if that was like, if the prices were made public, then everybody would want to compete with a fund manager, and every other retail investor that you meet would have become a fund manager in itself. So moving on from there, there is a question by an anonymous attendee. So I always tell Harshji, if there is an anonymous question, it means he's your fan. So a low churn of 14% over a month for large cap fund, is that good or bad?
So that's what I highlighted. I think there was some confusion because the fact sheet said 0.14% and Morningstar says 87%. So probably we'll just unearth this why there is such a huge difference. Obviously, 14% over a month is not a low churn ratio; it's a huge ratio. 14% over a month, and if I expand it for 12 months, that means almost 170% portfolio is being churned. That means uh, the fund, even if it is 100% churn, that means 25,000 crores worth of equity is being sold and bought throughout the year. So I think that contributes too much to the expense and is not a good sign that the fund manager is having a real long-term view of the stock that is holding. So churn ratio ideally should be below 50% over the year. The fund should not really have a high churn ratio. So 14% over a month is not low. It's quite high.
Okay. Vinod asks again that are these fact sheets submitted to AMFI, or who is the regulator for the same? I think he's coming from his company secretary background, and he's asking for a regulator on that.
Yeah, so these are all regulated documents. SEBI is the regulator for. So AMFI is not a regulatory body. AMFI is just Associations of Mutual Funds of India. SEBI is the regulatory body, and these are all regulated documents. And because they are given in print, you can always hold fund houses against if you find any discrepancies. So, but these are all very, very regulated. And to my mind, I think mutual fund is one of the most regulated industry, not only in India but worldwide. The kind of structure that we have, it is called a three-tier structure. When there is a fund house, then there is a custodian who's the trustee, and then there is a manager. So I think it is very, very well structured and very, very risk averse in terms of what can go wrong for an investor. I think SEBI in that terms is very, very pro investor and has been doing a phenomenal job.
So with that, I think, thank you, Saurabh. We come to an end to our Q&A session as well. I think it went brilliantly. What we've learned to see the mutual fund fact sheet today in a very different lens. So if any of you have any questions or anything, you can always send your questions over the email to Saurabh and me personally as well. Saurabh is at saurabh@cwa.co.in, while I am at Janay at cwa.co.in. So Saurabh will just put that.
My email ID for everyone to.
Saurabh, it's just gone into our attendees only. I'll just share it back. Yeah. Okay, so Vinod is saying he needs a part 2 on this fact sheets in depth. I think Vinod, you are also equally capable after this session to do a part 2 as well. So hopefully we'll have you around. With that, let's call it a wrap for tonight. Saurabh, any final comments?
Thank you so much for staying back. It's almost 1.5 hours, and thanks for being such a great audience and participating fully in all the polls and asking questions. I hope the session was of value to you. Let us know if you feel that any topics that you want us to cover. Vinod has already pointed out that we should do a more in-depth analysis of the fact sheet, which is very good. That if you are interested in that, let us know if you feel there are any other topics that you want us to cover, and we'll be more than happy to do that. Thank you so much.
Okay. See you. Bye-bye.
Bye.